In 2025, the United States imposed tariffs of up to 145% on some categories of goods. Trading partners retaliated. The last time the United States pursued comparable tariff escalation was 1930. This is that record. This is an archive of documented trade and economic data from 1929 to 1934. No predictions, no tickers. The historical record as it stands. Chapter 1. The Pre-Tariff Context. The United States economy in 1929 was at or near its cyclical peak. Industrial production was high and unemployment was approximately 3%. The stock market crash of October 1929 saw the Dow Jones Industrial Average fall approximately 48% from its September peak by year end. The recession that followed was severe but not yet catastrophic in early 1930. GDP had contracted, but the banking system had not yet failed. Chapter 2. The Smoot-Hawley Tariff Act. The bill had been drafted since 1929, originally targeting agricultural protection. Industry lobbying expanded coverage to over 20,000 categories of imported goods. 1,028 economists signed a public petition urging President Hoover not to sign. Their concern that trading partners would retaliate and that higher import prices would harm American producers dependent on imported inputs. President Hoover signed the act on the 17th of June, 1930. Retaliation came quickly. Canada responded within weeks. Britain's Import Duties Act followed in 1932. France, Germany, and others implemented countermeasures. Chapter 3. The Documented Trade Collapse. Between 1929 and 1932, world trade fell 66% by value. U.S. exports fell from $5.2 billion to $1.6 billion. U.S. imports fell from $4.4 billion to $1.3 billion. Both exports and imports fell approximately 70%. The tariffs designed to reduce imports also eliminated the export markets that U.S. producers depended on. Chapter 4. The Deepening Depression. U.S. gross domestic product fell approximately 27% in real terms between 1929 and 1933. Industrial production fell 47%. Unemployment rose from 3% to nearly 25%. The banking system began failing in 1930. Bank panics swept through 1930, 1931, and 1932. By March 1933, nearly half of all American banks had failed or been suspended. Whether Smoot-Hawley caused the depression is debated by economic historians. The documented observation, it coincided with a dramatic deepening of the trade collapse, and it did not prevent domestic contraction. Chapter 5. The Reversal. The Roosevelt administration passed the Reciprocal Trade Agreements Act in 1934, giving the executive branch authority to negotiate bilateral tariff reductions without returning to Congress. Within 4 years, the U.S. had agreements with 20 countries. The General Agreement on Tariffs and Trade of 1947 embedded the reciprocal approach into international trade architecture. Chapter 6. The Common Sequence. In 3 comparable historical episodes, the United States in 1930, the United Kingdom Corn Laws before their repeal in 1846, and the post-World War I protectionist wave, trading partners responded to each escalation. In each case, the protected industries did not recover to pre-tariff output levels in the short run. In each case, the resolution involved negotiated reductions rather than sustained tariff walls. The documented outcome of the Smoot-Hawley episode, it failed to prevent contraction, triggered coordinated retaliation, and reduced the size of global trade at the moment the U.S. economy needed external demand. Chapter 7. What the historical record shows. This archive does not predict what happens in any current trade environment. It documents the sequence the last time comparable escalation occurred. The archive stays open. The sequence is what the historical record shows.